High yield dividend dragon fighting warriors. It is now time to talk about QQQX, the triple QX, the Nuveen Nasdaq 100 Dynamic Overwrite Fund. What a cool name. Let's hope that there's also some really cool returns as well. All right, so what is this fund? Why does it even exist? So everybody, they want to own a piece of big tech. They want to own the next Apple, the next Microsoft, Nvidia, Amazon. These are companies that have consistently given high growth over the last decade. The problem though is that even though everybody wants to own the next big growth companies, volatility exists, and that can definitely be a problem. So when tech rallies, the gains are super explosive. But when tech fails, the drop can certainly be very painful. Now, some investors, they don't want that roller coaster ride. They want something steadier. And that's where triple QX fills in that void. It's a way to invest in tech while converting some of that growth into cash income. Now, what exactly is triple QX? This fund has actually been around for quite some time. It launched in January of 2007. That is over 18 years. This is a legal fund. It has 18 years of a proven track record of success. It's not like these other income ETFs that just launched like 5 months ago and people are already putting their life savings into it. Now, it is important to know that this investment is actually a closed-end fund. It's a CEF. Now, there actually is a difference between a CEF and an ETF. So a closed-end fund issues a fixed number of shares when it launches. So all the way back in 2007, when it went public, it only issued a fixed number of shares. After that, the shares trade on the stock exchange like a regular stock. Now, because of the supply and demand factor, as exists with any other stock, a closed-end fund can trade at a premium or a discount to the value of its underlying asset. This is called the net asset value, or the NAV. Now, this creates opportunities, guys. Sometimes the share price could be considerably lower than the NAV, which means you might be getting a discount on your investment. And sometimes it could be the other way around. The share price could actually be trading higher than the true intrinsic value, or the NAV. And that way you're actually paying a premium. But in this case, we can see here, you're getting nearly a 10% discount from what today's current share price and NAV is. Already you're paying 92 cents for a dollar. Would you want to pay 92 cents for every dollar? I certainly would. All right, let's talk a little bit about the investment approach. So triple QX owns stocks in the Nasdaq 100, the same companies that you'd find in the popular ETF, the triple Qs. But here's the twist. Triple QX adds an option strategy called a covered call. This is what turns this high growth index into an income generating machine. Now, covered calls, they are the secret sauce. So let's talk about this. So step one will be owning the actual stocks. This is the Apples, the Microsofts, Nvidias. Step two is they actually sell call options on these stocks. And the benefit of that is that they get paid these upfront cash premiums. And step three, they use that cash to pay out steady quarterly income to the shareholders. Think of it kind of like renting out your stocks. The rent reduces volatility and provides income, but the trade-off is that you're capping some of that upside if the stock rallies way too much. Now, this is also a dynamic fund. This means that there's going to be some active management involved. The fund managers, they actually sell calls on only 35 to 75% of the portfolio, depending on market conditions. This is very different than other ETFs that we cover in the space, where they're doing it on the entire portfolio. Now, that really limits the upside when they do stuff like that, but in return, they generally get higher distributions. You can see here, triple QX, it has a 55% long-term target. So they're leaving the room open for some capital appreciation. Now this means there's going to be more coverage in volatile times. So there's going to be more income, but less upside. But then there's going to be less coverage in bull markets, which means more participation in stock market rallies. All right, guys, when we look at their performance since inception, Since 2007, they have actually went up 33.65%, which is pretty good for 18 years, and to not see any of the dreaded words that we hate to hear. No, never erosion. Now, compared to the overall S&P 500, they've actually done pretty good. They've returned 10.31% annually versus the S&P 500's 10.41%. So they're basically neck and neck, almost identical. But one key caveat to this is that that's with dividends reinvested. If they hadn't reinvested dividends, so if you're hoping to actually retire off these, QQQX would have lagged a little bit more noticeably, since income is paid out instead of compounding. Now, compared to the overall QQQs, the QQQs have significantly outpaced QQQX, which has returned about 15% annually. So the bottom line is that QQQX prioritizes income plus stability over maximum growth. Now, income investors will love how consistent this fund has been. Since 2007, they have paid a quarterly distribution every single year. They have not missed any payments. And although they have been very consistent in giving out quarterly cash distributions, they have had a few dividend cuts in their history, and they haven't always raised their dividend every single year as well. Now, it's important to note that this fund did survive the great financial crisis of the 2008-2009 time period, and it also survived the forced COVID shutdowns during the early 2020s. So every year we can expect to get around a 6 to 9% dividend yield with QQQX. And over time, just holding on to this fund will likely get you a high yield on cost, assuming that QQQX continues to raise its dividend over the long run. For example, those that bought during the worst of the financial crisis are getting nearly a 25% return on their money every single year, which is absolutely absurd. This is why you gotta be greedy when others are fearful. Now, these distributions, they're gonna be a mix of options premiums as well as dividends from the stocks that they own. Now, they do pay out a lot of these distributions in return of capital, or ROC, which defers some of the taxes until you actually sell. For income-focused investors, QQQX can feel like a paycheck every single quarter. Now, some other things to consider about this fund: it does have a little bit higher of an expense ratio at 89 basis points. So when we talk about some of the NEOS products or the QQQIs, which have a lower expense ratio, this one is going to be higher, and it's also going to have a lower yield. It does have $1.4 billion in assets under management, which makes sense. It's been out for nearly 20 years. Ideally, people should be flocking into this fund. So who should really consider QQQX? And who should consider the QQQs? Well, the QQQs are really going to be for those pure growth investors. They want those cow-pounded big returns every single year in capital appreciation. They're very comfortable with volatility. There's going to be some years when QQQ does really well, but then there's going to be years where QQQ does very poorly. And of course, QQQ pays a very small dividend yield, less than 1%, so it's not going to be for income investors. There's no income focus for them. However, QQQX is an income investor's dream. It's very ideal for retirees or dividend investors who just need a fixed income. And it's perfect for those who want tech exposure, but with lower volatility. It's also for investors who like the idea of buying assets at a discount. And of course, there's always the balanced approach. Some investors hold on to both, QQQs for the long-term growth and QQQX for that steady income. My key takeaways here, guys, is that QQQX, it transforms tech growth stocks to an income-generating portfolio. You're giving up some of that explosive upside of the Nasdaq 100, but in exchange, you're getting quarterly cash flow of around 9% yield, you're getting reduced volatility, and you get to take advantage of some super juicy discount to NAV buying opportunities, as well as some tax deferral through their return on capital. Long story short, if you're somebody that wants maximum growth, those investors will likely just prefer the QQQs. If there's somebody that wants steady income, then maybe QQQX might be the better investment. But of course, there's nothing stopping anybody from just investing in both if they want a steady balance. Let me know what you think about QQQX in the comments below. If you want to see my full nearly $300,000 portfolio and all of my weekly stock trades, be sure to join the Patreon in the link below. If you want to talk to other like-minded dividend investors on your investing journey, be sure to join the Discord. We have some great conversations going on in there. Be sure to catch my videos in podcast form under the Collect Cash podcast name. Leave a 5-star review. It really does help out a small channel like mine. Leave a like, and I will catch you on the next one.
I just don't understand how you lose money in stocks.